First one we'll talk about is investing in markets. I think a lot of people who invest in think of investing, they probably think of this. Even if you own your own practice, you may have thought about opening like what's called a solo 401k or an IRA or something like that, but you don't really know what it is. And my guess is you probably think it's a lot of this. Data analysis, figuring out sort of which stock is going to move, which one's going to rise, which one's going to fall, when to buy, when to sell. In reality, when I'm talking to my clients, I want them to think about the stock market like this. Where should they be investing so they can sleep comfortably at night? Because you are not, I am, but you are not an investor. What you are is a therapist. What we want to do is increase your wealth while you're able to sleep at night, while you're able to refresh and do what you do, which is, help people through, significant troubles and whatnot. And so to understand that, we first need to understand why we invest. And to do so, we invest in order to access risk, because you can't have money grow over time unless you're accessing risk in some way. And one of the best ways to do this is through low cost, low fee, broad-based index funds. And with that risk, we can help them grow over time. And without that risk, what we're essentially doing is putting money in the couch cushion. And 20 years from today, if we do that, what we're going to have? We're going to have the same amount of money in the cash cushion. And that's it. And that sounds great. Hey, I put $100,000 in my couch cushion. That's $100,000 20 years from now. That sounds great. Except you're dealing with another factor, which is inflation. We've all experienced this over the past few years. We've seen prices rise and whatnot, but we don't necessarily see the full impact on it when we're talking about 20, 30 years down the line. And so sometimes, numbers can help, but essentially in order to, buy something that was $1 in 2004, you would need $1.62 today. To buy something that's $1 today, if you can find it today, you need $1.64 in 2044, 20 years from now. But it gets, to put it a different way, if you had 10,000 in 2004, you would need the equivalent of 16,130 today. And to have the equivalent of 10,000 today, you'll need 16,387 in 2044. So you can see how the impact of just putting it in the couch can really be detrimental to your long-term goals. And so what we want to do when we're investing is understand where the money's going, what type of risk we're taking on, and does that risk allow us the growth that we need by the time we need that money? And so one of the best ways that we do this is invest in what's called broad-based index funds. And so what a broad-based index fund is, essentially, we're not taking bets on any single stock. What we're doing is investing in a large part of the market. So this is the returns of the S&P 500 or the 500 largest US companies. And as you can see, over 10 years, these are annualized returns. There's a lot of up and downs. Like there's a significant up and down here when COVID hit, for example. But if you take it over 10 years, you see an average annualized return of about 12.59%. I mean, that's great. That's far more than inflation, and that's allowing our money to continue to grow at a significant rate. It's the same if we look even further. This is the historical return of the S&P since 1957, which is when it became 500 stocks. And you see there's a ton of up and down that people experience over that time frame. But if you just even it out and say, hey, what was the total return over that? The average annual return was 10.26. That's fantastic. If we include inflation in that, it's between 6.5% to 7%. Still far greater than the rate of inflation, which is about 2 to 3% on any given year. And so you can see how accessing this risk, the S&P 500, can, while into the short term can create some real volatility, over the long term, it can allow our money to grow significantly. And why is that? One is because this is assuming we're reinvesting the dividends. Companies like to reward their investors. And one way they reward them is by saying, hey, we have all these profits. We're going to give those profits back to you in the form of dividends. This is basically extra money that came from the company. You're able to then take that money, reinvest it in, the same in the funds and whatnot, and now you have more access to more ownership of those funds, and that begins to compound over time. We're also not moving in and out of the market, so our money is growing without any tax concerns, because as long as we're leaving it in place, there's no capital gains, there's nothing like that. And so we're gaining from the lack of taxes over time. And what we're really doing is just capturing basic economic growth, both in the US and the world. And so by doing so, as long as the world economy grows over time, we should see our investments grow as well. Here's what we're not doing. We're not picking that stock that we love. We're not trying to find the next Tesla. We're not trying to find the next Google. We may own those companies through the broad-based index funds. In fact, we almost certainly do. And so we'll gain from if they pop, if they don't, but we won't put all our eggs in the so-called basket. We're also not looking to get rich quick. There's a lot of people out there who are putting everything into crypto right now because they're hoping that they get rich quick. And who knows how that's going to work out, but they're increasing their risk significantly in order to take that bet. But we don't want a roulette wheel, a type bet, when we're talking about our future. And so this is a strategy to grow wealth over time. And the other thing we're not doing, sorry about that, is looking to find the perfect time to buy, to sell, buy, sell, pulling in and out of the market, trying to predict whether it's going to go up or down. This just doesn't work over the long term. In 2008, when the financial crisis hit, a lot of people pulled their money out of the market. In 2011, Fidelity did a study. They found that those who pulled out of the market from 2008, October 2008 to March 2009, basically when the market was falling, and never bought back in, they only saw their investments increase by 2% by 2011. But those who pulled out and then bought back in, they saw their investments grow by 25% by 2011. Those who just stayed the course, didn't do anything, they just rode the wave, they saw their investments grow 50% by 2011. And those who kept buying into their strategy over that time frame saw their investments grow by 64% over that time frame. So as you can see, it's not really advantageous to sit there and try and time the market, because we're going to be wrong. And if we're wrong, then we suffer for it. And so we're trying to avoid that. So what are we doing differently? It's quite simple. One, we're diversifying. So we're looking at the broad-based markets. We're trying to ensure that we're capturing everything within that market, because we don't know what's going to happen here or there, or every wind shift and whatnot. But we know over time the economy will grow, both the U.S. and the world. We expect it to, and then as long as it's growing, we take advantage of that. We're using tax advantage accounts. Sometimes these are tax advantage, sometimes these are tax deferred, but we're using the tax code to our advantage to make sure our investments are growing and we're not having to pay Uncle Sam in the process. And then third, what we're doing is figuring out the goals we have for this money. Is this money gonna afford our retirement down the line? Well, we're going to take that into account when we're growing this, and we're going to choose a risk structure that makes sense to make sure that that money is available when we need it. And that's really how we're investing. We're not investing to say, hey, I just want as much money as possible. Instead, we're figuring out how we want to invest, what we need this money for, and that will determine where we invest. And that's really the difference between what you may think of investing in the markets versus what the reality of investing in the markets is. Now, I want to take a quick side note, because I know this comes up in private practice, is whether to go the solo 401k or SEP IRA. And these are tools, these are tax deferment tools that you can use in order to invest within your business. And so I'll talk briefly about them. The solo 401k, this is really only for single solo practices. If you have a partner, a spouse that you can bring into the business, it can be really valuable, because if you're paying them, they can actually invest in the solo 401k as well. And all of that is tax deferred investment. So you're not paying taxes on it. at that point. And you can see the max limit is incredibly high in those cases. And it's because, when you have a solo 401k, you're giving yourself the employee contribution. This is the same type of contribution that you might get if you are a W-2 worker somewhere, and that you can put up to $22,500 a year into the account. But you're also the employer. When you're a W-2 employee, you might get some match from your employer, but they're not going to be like, hey, we're going to beyond the match. We're just going to give you $40,000. That's not going to happen. But in the solo 401k, since you are the employer, you can actually give that to yourself. There's the rules in terms of how much. It's 25% of the revenues, basically, of compensation. So you have to be careful about that. But as long as you are in line with that, then you can put quite a bit in there. And you also have the advantage of catch-up contributions if you're over 50. And again, they're tax advantaged in that you're not paying taxes until you're ready to use them in retirement or something like that. The SEP IRA, it's not used for solo practice. I mean, it can be used for solo, but it's if any more than one employee, then you're gonna have to use the SEP IRA over the solo 401k. They have similar limits to the 401k, but you can only contribute up to 25% of employee compensation. And if you decide, hey, I'm gonna give myself 25% of compensation, then you have to give everyone in your group the same, or anyone who's part of the SEP IRA the same compensation. And that makes it a little different than the solo 401k. You also can't necessarily give yourself employee contributions because it's only employer contributions. And then, if you give to yourself, you have to give to others. That's the main rule within the SEP IRA. The more education, the more advice, the more guidance you have, the better off you're going to be. To get more information, I have a free download about turning private practice income into wealth. And you can find it at thinkingcapfinancial.com/income to wealth. It's a free download. And you'll be able to read deeper into some of the topics that we talked about today. And then if you have any questions, feel free. You could actually scan the QR code right from your computer screen if you wanted to, and put time on my calendar, free 20-minute consultation. I'm happy to do it, and I look forward to it. And then if you have any questions, you see my email there as well. But thanks for listening, and I hope to be in touch soon. Have a good one.